Take a moment and think about something simple. The cash in your wallet, the balance in your bank account, the interest rate on your loan, even the price of your house. Most people assume these things are shaped by governments, elections, and public debate. But if you trace the history carefully, you discover something surprising. Many of the most important decisions about money were not made in public assemblies. They were made quietly, in private rooms, by a very small number of people. The beginning. Order out of chaos. In the early 1600s, Europe's trade networks were expanding rapidly. Ships traveled between continents, carrying spices, silk, silver, and ideas. But merchants faced a frustrating problem. Money itself was unreliable. Coins came from dozens of kingdoms and city-states. Some had been shaven down, some mixed with cheaper metals, and many had uncertain values. Trade became slow, and arguments were common. In the Dutch city of Amsterdam, which was quickly becoming one of the world's busiest trading hubs, merchants and city leaders decided something had to change. So in 1609, they created a new institution. It was called the Bank of Amsterdam. Instead of constantly exchanging unreliable coins, merchants could deposit their metal at the bank and receive a balance recorded in its ledgers. Suddenly, trade became easier. People trusted the numbers on the books more than the coins themselves. It was a revolutionary idea. For the first time, large-scale commerce began to rely on recorded credit instead of physical gold and silver. But there was an important detail. Control of this trusted system rested in the hands of a small group of administrators and merchants. Money had become more efficient, and, quietly, it had also become more centralized. The next step: financing a kingdom. Almost a century later, a different kind of crisis appeared across the North Sea. England was deeply involved in expensive wars, and the royal treasury was running dangerously low. The king needed money quickly. In 1694, a group of financial backers offered a solution. They would lend a large sum to the government. In exchange, they asked for permission to establish a powerful financial institution that could manage government debt and issue banknotes. That institution became the Bank of England. At first glance, it looked like a patriotic project designed to strengthen the nation, but it also created something entirely new. For the first time in modern history, a government's finances became deeply intertwined with a banking institution operating alongside the state. The bank's notes gradually became widely accepted as money, and government borrowing turned into a permanent feature of national policy. The concept of national debt was no longer temporary. It became part of the financial system itself. A family network across Europe. By the early 1800s, finance had grown more international. Trade routes stretched across continents, and governments increasingly relied on financiers to raise capital. One banking family became particularly influential during this era: the Rothschild banking family. With branches in major cities like London, Paris, Vienna, and Frankfurt, they built a communication network that moved information faster than most governments could manage. Private couriers carried news across Europe, giving them a powerful advantage in financial markets. During the aftermath of the Battle of Waterloo, for example, information about the outcome spread unevenly across the continent. Those who learned the news first had enormous opportunities in government bond markets. Stories from that period, some exaggerated, some true, helped cement the Rothschilds' reputation as masters of international finance. But the deeper lesson was not about one family. It was about a new kind of power. Information and finance were becoming tightly connected, and both often flowed through private networks rather than public institutions. A crisis in America. By the early 1900s, the United States had become one of the world's fastest-growing economies, but its banking system remained unstable. Financial panics occurred regularly. Banks failed. Savings disappeared. The most dramatic moment came during the Panic of 1907. Markets collapsed, confidence vanished, and depositors rushed to withdraw their money. The government struggled to respond. Instead, the rescue effort was organized by one of the most powerful bankers in America, J.P. Morgan. In an extraordinary moment, Morgan gathered leading bankers in his library and pressured them to coordinate a rescue plan. The crisis eventually stabilized, but this event raised an unsettling question. If the financial system depended on one private banker to survive, what would happen next time? A secret planning session. A few years later, in 1910, a small group of bankers and politicians traveled quietly to a secluded island resort off the coast of Georgia. They avoided reporters. Some even used first names instead of their full identities. Their destination was Jekyll Island. Inside a private club on the island, they spent several days discussing a plan for a new American central banking system. One of the key participants was Nelson W. Aldrich, a powerful senator involved in financial policy. The discussions there helped shape the blueprint that eventually led to the creation of the Federal Reserve System. In 1913, the Federal Reserve Act was passed, establishing the United States Central Bank. Its purpose was to stabilize the financial system, manage liquidity during crises, and guide monetary policy. From that point forward, the Federal Reserve would play a central role in determining interest rates and influencing economic conditions. Global coordination. As the global economy became more interconnected, central banks began coordinating with each other. In 1930, a new international institution was created in Switzerland. It was called the Bank for International Settlements, located in Basel. Often described as a central bank for central banks, the BIS provided a place where monetary authorities from different countries could meet and discuss global financial stability. Its meetings were typically private, allowing policymakers to speak freely about sensitive financial issues. Over time, the organization became an important hub for international financial cooperation. Designing the post-war system. Near the end of World War II, world leaders understood that the global economy would need a new framework once the war ended. In 1944, representatives from 44 countries gathered at a conference at Mount Washington Hotel. This conference became known as the Bretton Woods Conference. Two key figures dominated the economic discussions: John Maynard Keynes, representing the United Kingdom, and Henry Dexter White, representing the United States. The final agreement established a system where global currencies were linked to the US dollar, and the dollar itself was convertible into gold. The conference also created two institutions that still exist today: the International Monetary Fund and the World Bank. These organizations were designed to stabilize international finance and support reconstruction after the war. The end of the gold era. For decades, the Bretton Woods system functioned as the backbone of the global monetary order, but by the late 1960s, economic pressures were building. The United States was spending heavily on both domestic programs and the Vietnam War. Dollars circulated worldwide in quantities that exceeded the Americans' gold reserves. Foreign governments began exchanging their dollars for gold. Faced with this growing pressure, Richard Nixon made a dramatic announcement in August 1971. The United States would suspend the dollar's convertibility into gold. The decision effectively ended the Bretton Woods system. From that moment on, most global currencies became fiat money, their value based on trust in governments and central banks rather than a physical commodity. The system today. Today, central bankers, economists, and policymakers still meet regularly to discuss the future of global finance. One of the most well-known gatherings takes place each year at the Jackson Hole Economic Symposium hosted by the Federal Reserve Bank of Kansas City. Ideas presented there often influence financial markets around the world. Meanwhile, new developments such as central bank digital currencies are being explored by governments and monetary authorities. Just like in the past, these ideas are often discussed first in expert committees and policy forums before they reach the wider public. The bigger lesson. Looking back through history, one pattern becomes clear. Financial systems do not simply appear on their own. They are built, designed, negotiated, often during moments of crisis. Understanding this history doesn't mean believing in conspiracies, but it does remind us of something important. Money is not just a tool of exchange, it is also a system shaped by decisions, institutions, and power. And the more we understand how that system evolved, the better prepared we are to navigate it, because the rules of money have changed many times before, and one day they almost certainly will change again.